Welcome to the Candlestick Forum Bullish Harami training session. Hello, my name is Steve Bigelow. I've been trading for over 35 years in the markets. About 25 years ago, I came across candlesticks. I've written 3 books on how to use candlesticks successfully, either by identifying them, understanding the psychology that created the signals, and the 3rd book was how to correct your emotional faux pas using candlestick analysis. And one of the major things I discovered over the past 25 years was that out of the 50 or 60 signals in candlestick analysis, there's only 12 major signals that you really need to learn. Once you learn those signals and understand the psychology that created those signals, you now understand why the markets move as they do. And the bullish harami is one of the 12 major signals. If you understand why this signal occurs and where it occurs most often, you'll understand a good percentage of why candlestick signals work effectively at different periods in a price trend. The bullish harami is very simple to identify. In Western terminology, it's known as the inside day. It opens above the previous day's close and it closes below the previous day's open. In Japanese terminology, harami means pregnant woman. There's her body and there's her belly sticking out. But essentially it tells us that the selling has stopped. The harami is a very good indicator to tell you that a downtrend has stopped. As we can see in this chart, we had a bullish harami. Does it mean it necessarily is going to start an uptrend? Not necessarily, but at least it tells you that the downtrend has stopped and that if you're short, this is a good time to be covering your shorts. With additional confirmation, like a strong open, that tells us that we're in an uptrend, and we'll be going through that more specifically through these charts. But essentially, if you see a bullish harami where the stochastics are close to the oversold area, and you see them gap it open the next day, that pretty much tells you that the selling has not only stopped, but the bulls are back in there with good enthusiasm. So to indicate that a trend reversal has occurred versus just a downtrend has stopped, it requires strong confirmation. Going back to one of the basics, the nice thing about candlestick analysis is that the Japanese rice traders put human emotions into a graphic depiction. Where do most people sell? They panic sell at the bottom. As we can see, there was a big sell-off down here at the bottom. Next day we have a bullish harami in the oversold area. The probabilities are pretty strong that not only has this downtrend stopped, but on a positive open the next day, the uptrend starts. Now, this is a very simple chart to analyze because when it did start, where was our first major target? Right back up here to the 50-day moving average, and then we could see what type of signals we had at that point. So on a bullish harami, if we see a gap up the next day, that not only tells us that the downtrend is over, but a new strong uptrend could be in progress. Again, with the stochastics in the oversold area, just a very simple statement. If you see a candlestick buy signal confirmed in an oversold condition, there's an extremely strong probability that you've reversed the trend and you're going in the other direction. And a bullish harami needs confirmation the next day to tell you whether they're taking it up or whether they're just flattening out the downtrend. In this case, as we can see, the confirmation after a bullish harami, which told us the selling had stopped, was the next day they told us the bulls were in here with great enthusiasm. Notice the T-line. Remember, on our charts we have the 200, the red line, the 50-day moving average, the blue line. The gray line is the 20-day simple moving average. Those are all simple moving averages, and we use those because every major money manager around the world uses those moving averages to indicate or to make decisions on what to do with their portfolio. And then the black line, which is what we call the T line, the 8 exponential moving average, very simple. If you see a candlestick buy signal and a close above the T line, your trend has reversed and you can stay long as it doesn't close back below the T line. One of the major rhetorical questions in investing is, when do you grab for that fallen knife? Japanese candlestick analysis makes that very simple. Notice we have a downtrend in the oversold area as far as stochastics, and they gap it down. When you see a gap down in an oversold condition, start looking for a buy signal. When do you grab for that fallen knife? When you see the candlestick reversal signal. Notice this bullish harami closed or told us that the selling had stopped. The gap up next day told us that not only was this downtrend over, but a good strong uptrend could be in progress. A strong downtrend, a bullish signal. Now, you can have bullish signals, but they need to be confirmed. Notice right here we had a bullish engulfing signal. However, they did not confirm it the next day. A few days later, they had a bullish harami. They did confirm it the next day with a follow-through that told you that if it opened positive the next day, the bulls were in control. As with all candlestick trades, the more criteria we can put together to make the probabilities in our favor, the better off we're going to be. Notice in this downtrend, we have a bullish harami. Tells us the selling has stopped. And notice where it closed. Closed right on the T line. Made this a very simple trade. If it opened positive the next day, not only was it confirming the bullish harami, but it was also telling us the T line was not acting as resistance. As we go further into this analysis, we did a doji. If it opened positive the next day, that's a simple rule of the doji. It's going to move in the direction how they open it after a doji, which means we're still going to have an uptrend. Basically a doji sandwich that now has created more criteria for being in this position. Number one, it's moving in the positive direction after a doji. Number two, a positive open breaks you out through this downtrending channel. Tells you there should be a good strong price move after that. Remember, anytime you see a candlestick signal, a doji sandwich, there's usually more upside after that doji sandwich. And anticipating when the bulls are about ready to take control is analyzing a chart to see when do most people sell. They panic sell at the bottom. Next day, when we see bullish haramis, we can see that the selling has stopped. We want to be able to buy on the next confirmation. In this case, there was no confirmation the next day. It sold back off. Then we had a doji followed by a gap up and a close through the T line. This itself is a signal, but if you add the fact that they stopped the selling over here, it just lends that much more credibility to that signal that we are going to be in a strong uptrend. If you're in a mucky trend such as this, and then you see a bullish signal confirmed, the probabilities are pretty good that the worst case scenario is they're going to bring it back to the top of the trend channel. But as we can see, once they stopped the selling and gapped it up, that told us there was good force coming back into this trade. That once they got to the resistance level, next move was they gapped it through it. That created a very strong uptrend. So you could either have bought it here, or you could have bought it down here after a bullish harami followed by a gap up, especially in the oversold area. That's pretty much telling you that not only did the selling stop, the bulls were in with good force and enough force from here to possibly break it through this level. Worst case scenario, get up to this level, failed, you come back out with a small profit instead of the potential of a big profit. When do you want to start watching for a potential reversal signal? When your stochastics are down here in the oversold area. As we can see, downtrend, 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 big selling at the bottom of the downtrend in the oversold area. That's the time when you start coming in and start looking for that buy signal. In this case, seeing it open lower, open positive above the previous day's close or at the previous day's close, and then closing below the previous day's open. We know that if we see this start forming up, that we're going to have a bullish harami. We should be ready to watch to see if they're going to trade it positive the next day. Another aspect about candlestick analysis is we know that a signal provides a strong potential for a reversal, which means we also know that the lack of a signal probably does not mean a reversal, maybe just a short-term bounce. As we can see in this chart pattern right here, this is not a candlestick reversal signal. It's not a bullish engulfing signal, which meant it should have opened below the previous day's trading. It's not a bullish harami because it closed above the previous day's open. This is just an up day and a downtrend, which usually indicates that the whatever move is not going to be a sustained move until they pull back and then do a candlestick buy signal. And like most candlestick signals, bullish confirmation is required. In this case, when they told us the selling had stopped and then they gapped it up the next day, that simply told us that the downtrend had stopped and now a new uptrend is going to be probably starting with great force. Also note, which we'll get into later, the higher this candle closes on the previous day's close or in the previous day's body, the higher the probability you're going to be in a strong uptrend. And further confirmation is a bullish harami with a gap up and a close above the T line. When you start adding all these elements, especially when they're in the oversold area, the probabilities of being in an uptrend is extremely strong. As we go through these charts, we're probably going to see a lot of repetition. That's not to insult anybody's intelligence. That's because candlestick analysis is a highly visual and analytical tool. So the more we can put into our mind's eye a proper or a correct trend reversal, the higher the probabilities we're going to be in right positions at the right time. And another element is the further you move away from the T line, the higher the probability they're going to come back and test it. So if we're in the oversold area and we see a bullish harami, more than likely they're at least going to bounce up to see what it does at the T line. At that point, we can analyze whether it failed at the T line, which means the T line is still acting as a resistance level, or whether they take it through. So on a positive open, the probabilities are that at the worst case scenario, you may have a little bit of leeway that if you see a failure up here at the T line, you can still get out at least flat or even with a little small profit. And knowing that candlestick analysis is the graphic depiction of human emotions, we can see graphically when their panic selling is starting. Notice how the candle starts to get bigger, then they gap it down and have another big candle and you're in the oversold area. This, to a Japanese candlestick analyst, tells us that we want to be ready to start watching for at least a bounce, and that comes in how do you grab for the fallen knife? When you see that first candlestick signal and then it confirms the next day. Very simple. The further you are away from the T line, notice the big selling, the higher the probability they're going to come back up and test it. This allows a candlestick investor to make a decision of what to do once it gets to this level. If it fails, you're back out. If it stays long, you're going for the next, probably the next resistance level. And the signal doesn't have to be significant. Just a small harami tells us the same information, that this downtrend is over. This was confirmed by a positive open and a close above the T line. Notice all the elements we have for making this a good trade. The selling has stopped. The bulls have stepped in, confirmed with a gap up. Number one. Number two, they close above the T line. That is a confirmation. If you need further confirmation, a positive open the next day takes us out of this downtrending channel and well above the T line with stochastics coming up. Anything we can do to add credibility to a trade, the higher the probability we're going to be in the correct trade at the correct time. And also note, this bullish harami had a tail to the bottom side. The only significance of that is the bears are still knocking this down, but then they reversed it, came back up through the open, and closed it higher. That's more evidence that the bears are now out of the way, and the bulls are starting to take control. Once again, we had that double confirmation of a positive open and a close above the T line. Significant factors to tell us we might be at the bottom. Once again, a big down day in the oversold area. Remember, the harami doesn't have to be a strong, big signal. All it has to do is tell you that the selling has stopped. Then we start looking for the bullish confirmation. And when it finally closes up above the T line, you can look back and say, all right, this did start from a bullish harami in the oversold area. That reversed it, and now I'm above the T line. You continue to stay long until you see a candlestick sell signal and a close back below the T line. Bullish harami, gap up, close above the T line. If you didn't buy it on this day, it becomes an easy entry on a positive open up here. Why? Because that tells you they've broken out through this downward trend channel. So they probably had a wave 1 over here, a wave 2, going into wave 3. Once again, we had a situation over here where we really didn't have a powerful reversal signal, which meant this was probably just a bounce. It was when they backed off and did a bullish harami and then confirmed that our uptrend actually started. More than likely, when you have a small harami at the end of a big candle, at the lower end, if it doesn't open up real positive the next day, your trajectory may be like this. If it gaps up, your trajectory would be more like this. The harami acts as kind of a barometer. So add up all the factors. Stochastics oversold. A spinning top, doji type harami. Anytime you see a doji formation and it's a combination of another signal, it's usually going to have a little bit more power to that reversal. So you have a doji harami, a gap up, and then a close above the T line, stochastics coming up, all the indicators telling you this trend is reversed and it's probably going to start up with good strong force. The stronger that confirmation, the higher the probability you're in an uptrend. Bullish harami, again, note the selling at the bottom of this downtrend. Usually a big candle, to say usually a big candle, probabilities are that you're going to see a big candle in the oversold area. Start watching for a buy signal. If you see a gap down in the oversold area, start watching for a buy signal. True confirmation is not only coming back up and testing the T line, but closing above it. As you can see, once it closed above, there was no worry about holding this position until it closed back below the T line. And even when the confirmation isn't real strong, you can still look for the next couple of days to see whether the bulls are stepping in. Bullish harami, spinning top, a little positive trading the next day, still indicates the bulls are starting to come in. When they open up positive the following day, that's a good place to buy. You still on that close have to see that it trades up above the T line, which we did. This is all evidence that the bulls are now taking control and being confirmed with the stochastics coming up. A big down day followed by a big bullish harami. Very simply stated, like all candlestick signals, the bigger the reversal signal, the higher the probability there's been a change of investor sentiment. Look for bullish confirmation. And don't throw away the analysis if it doesn't confirm immediately. Big bullish harami, came right back up to the T-line and failed. You're back out of the position. But remember, we were buying this because there was buying coming into this trade. The next time they take it back up through the T-line, you want to be a buyer. Why? Because this indicated there was buying going on. This indicated failure. This indicated new buying going on. This whole setup told you the bulls were starting to take control. Bullish harami didn't look real positive that day. Bullish candle above the T-line, that's when you can start buying. This still indicated the selling had stopped. Start watching for the buy. The further you move away from the T-line, the higher the probability they're going to come back up and test it. That was evident with the big, huge selling at the bottom, the panic selling. This is where the psychology of a candlestick investor gets turned around completely. Prior to candlesticks, I was one of the worst investors in the world. I would be selling when everybody else was selling, thinking, well, this is bad news. Who the heck is buying this? And usually it was the smart money buying at the bottom. Now I've got myself mentally set up that if I see all the factors for selling, that they're panic selling, I'm starting to watch for the buy signal. This turns your mental decision making around 180 degrees, that you are buying on the bad news versus selling on the bad news, and you're selling on the good news, not buying on the good news. So it's pretty obvious that in a downtrend, if you see a bullish harami at the end of it, be ready to start buying, especially if they gap it up. That's usually going to be a strong indication that the trend has reversed. So like all other candlestick signals, gap ups after the signal is a very strong confirmation. Not only a strong confirmation that the trend is reversed, but the trend is going to be relatively strong also. So use that to your advantage, that if you see a harami, stochastics in the oversold area, if they open up positive the next day, you want to be buying, especially if they gap it open the next day. That tells you not only have they changed their investment sentiment, but the new sentiment is fairly strong. Additionally, bullish harami followed by a gap up and a strong reversal signal or a strong confirmation is that much more compelling that your uptrend's in progress. The further they've closed this up above the T-line, the more safe you're going to be, because you know you're going to use the T-line as support, and as long as it stays above the T-line, you want to stay long. Spinning top, doji type harami followed by a gap up. Just this factor right here, a spinning top doji followed by a gap up, is your best friend. If you add the fact that it's a harami telling you the selling has stopped, it's that much more credence that there's going to be a strong uptrend from this point. This is not an unusual chart pattern. Bullish haramis, and the harami could also be a doji, a hammer signal, but then if they gap it up, not only gap it up to the T-line, but gap it above the T-line and head positive, that's an indication that the uptrend is going to be real strong. So anything that we can put into our favor of being able to see when the bulls are coming in with strength, this does it very graphically for us. With all candlestick signals, the bigger the signal, the higher the probability the reversal has occurred. The alert in this case is a big down day in an oversold condition. The bigger this candle is coming back, the higher the probability investor sentiment has turned around and going positive. Where do most people sell? They panic sell at the bottom. When do we want to buy? We want to grab that fallen knife when we see a candlestick reversal signal. And again, the harami is a strong indicator that the selling has stopped. It also makes for a very simple stop loss. If this candle tells us that the selling has stopped and it opens positive, where should it not trade the next day? The Japanese rice traders are very adamant that it shouldn't trade back below the halfway point of this candle, because if they can start trading back below the halfway point of this candle, that means the bears are still in control. What we should be seeing on a bullish harami is positive trading. Anything that starts coming back in this direction tells us that maybe the signal is not working. That still leads to a probability situation. The probabilities of a candlestick reversal signal being seen in an oversold condition are extremely high that it's going positive. Whether those quantitative statistics are 55% or 80%, it doesn't matter. It's well over 50% is going to take you in this direction. If it wasn't, we wouldn't be looking at these candlestick signals today. The Japanese rice traders used these signals not only to become wealthy, but became legendarily wealthy in Japan, that they were the powerhouse or the financial powerhouse for many centuries. So they had a lot of time to analyze when the reversal was occurring, what the graphics would look like, and what the probabilities were that that signal was going to give them a profitable trade. The larger the signal, the more compelling the uptrend is going to be strong. Downtrend, gap down, big down day in an oversold condition, start watching for buy signal. If your buy signal is a bullish harami, we also know that the bigger this signal is, the higher the probability you're in a strong uptrend. The higher it closes on the previous day's candle, the higher the probability you're going to be in a strong uptrend. And a positive open after a bullish harami, the probabilities are pretty strong you're going to be in a strong uptrend. And what do haramis imply at support? You got to remember, everybody is watching technical levels on charts. We have the advantage of seeing exactly what the investor sentiment is when it gets to these technical levels. This makes it very easy to understand what's happening once we get to a support level, such as the 50-day moving average. The message here is that all the institutions or all the big money that might be waiting for this pullback to hit a support level, when they got there, they're buying. We can see that immediately. I've often asked, how many days does it take to show that there's been a trend reversal? The answer is none. If we see a bullish signal, such as a bullish harami, especially right on a support level, stochastics in the oversold area or curling back up, if they open up positive the next day, that's our confirmation. This is the signal that the Japanese rice traders have brought to us over hundreds of years to tell us a very simple entry strategy. If you see a bullish harami in the oversold area and it opens positive the next day, you want to be a buyer. Where are these signals occurring? If you can identify that the buyers are stepping in right at a level where it's supported a few times before, makes the credibility of this signal that much greater. Once again, a big strong signal closing right near the top of the trading range tells us on positive trading from here there should be a strong uptrend. Witnessing a bullish harami right on the 50-day moving average tells you exactly what you want to know, that there are buyers at that level. You want to be buying on any positive confirmation. Or if you see it supporting right on a major moving average like the 200-day moving average, that also tells you that the big investors were waiting to see how far the pullback was going to go, and if they hit their support level, they were buying. We can see that immediately. Any additional information that provides more credibility that that's where the buyers should be stepping in helps us out. If we can see that there's kind of a base here or a bottom support, and once they pulled up, pulled back, and the bulls stepped right back in at the same level, that's much more credibility that we're back in an uptrend And again, this can happen on a daily chart, a weekly chart, or a monthly chart. Or if you're trading the E-minis, you can be using the 1 minute, the 3 minute, the 10-minute chart. The signals work exactly the same on the 1 minute chart as they do on the monthly chart. It's the accumulative knowledge of everybody buying and selling during a specific time frame. Where do you think everybody else is watching on this pullback? Waiting to see whether it's going to support at the 50 or not. When you start seeing that signal, the bullish harami, previous day also touching the 50-day moving average, this told us as soon as they got down here, they couldn't get through the 50, and the bulls started stepping in. Confirmation was a gap up the next day, back up through the T-line. Eventually started a very strong uptrend. Additional confirmation comes from moving up, trading right there at the 50-day moving average. A bullish harami telling us the selling has stopped, closing right on the 50. If it opens positive, tells us the 50 is not acting as or it's acting as support. They gap it open above the T line. This is just added information, added confirmation that we're going to be in a strong uptrend. The visual confirmation that the buyers are stepping in right at major moving averages like the 200-day moving average allows the candlestick investor to be prepared immediately for what to do the next day. A bullish harami is where you have all the major buyers ready to wait to see if a major support level is going to act as support, and we can see immediately that it does. I know many other techniques that require 2 or 3 more days to confirm the reversal has occurred. They are the fodder for allowing us to get in at immediately after a confirmation of a bullish harami. They're the additional profits because as they're coming in, we're already in making a profit from that immediate decision. It is not an uncommon occurrence to see a harami form right on a major support level. Again, that's the information that we get immediately, that other people are stepping in at that level because they feel that major support level is going to act as a support level. Knowing that we could possibly see that type of situation, this allows the candlestick investor to anticipate that if we're in the oversold area and they have dropped hard down to and below a support level, watch to see what they do the next day. If they open up positive and start trading up positive, you know there's probably been a reversal. The aggressive buyers can start getting in immediately with at least half a position, knowing that if it does do a bullish harami, confirmation would be seeing positive trading the next day. Then they can come in and do the other half a position to have a full position ready to go for the uptrend. And I reiterate this type of setup because this is quite often what happens right on a major moving average, is to see the bullish harami show that the selling has stopped. Perfect case of where the prices move. They'll move sideways until they get to a support level, and then you'll see new buying. We have the benefit of seeing that the buying is starting right at the moving average, not a bounce, but an actual signal that tells us that if they open up positive the next day, we definitely want to be a buyer. Even on pullbacks, if you see an uptrend and then a pullback right to a major support level, gives us the information immediately that this was just a temporary pullback and they were looking for support and they found it with the bullish harami. This basically tells you what is the big money doing once it gets to a support level. Having the knowledge of what type of signal might form at a support level allows the candlestick investor to kind of move a little bit quicker and be prepared, either buying that day or buying on any positive trading the next day without any hesitation. having the anticipatory abilities allows pre-strategies, so that you're not shooting from the hip, that the night before you can be already setting up your strategy to say, if this opens positive tomorrow, I definitely want to be a buyer. And it is not unusual to see the formation of a bullish harami right smack dab on that support level. This basically tells you where the buying is occurring, and that buying is occurring at that level. Note how it opened lower the next day. Very simple trading strategy for an entry strategy. If it opens lower and you see it start moving up, just put your buy stop at where it closed the day before, because if it opens here and starts up through that level, you can tell it's already creating a white candle at that point. More than likely, if it comes up through the previous day's close, the bulls are in control. And as we can see, a bullish harami can have different names. Notice the inverted hammer harami did the same thing. It opened inside the previous day's close, closed inside the previous day's open, and also formed an inverted hammer. We know very simply that if it opens positive after a harami, you want to be a buyer. If it opens positive after an inverted hammer, you want to be a buyer. And note how this inverted hammer signal forms right smack dab on the 50-day moving average. This allows for two things. Number one, to get in early. Also, it allows for a much less stop loss risk, that if this didn't work, we don't have a big move to come back and get stopped out. But the probabilities are that we're going to be moving higher, with very low probabilities that would ever get stopped out of a situation like this. The reason for that: an inverted hammer, a bullish harami, stochastics in the oversold area, a positive open. The Japanese rice traders say that the probabilities are extremely high. We're now in an uptrend. A bullish harami, gap up, hammer signal, right at the 50-day moving average, stochastics coming up. Further confirmation. They close it above the T line, break out through this downward trend channel. Again, all these elements, the more elements you can add to make sure that you're in the right position at the right time, the higher the probability you will be moving in the right direction. And also, with a gap up, the probabilities of a strong move are fairly strong also. So aspects that allow us to decide what the barometer is telling us, very simple. The higher the close on the previous candle, the stronger the reversal is probably going to be. As can be seen in this one, it wasn't a big candle, but notice it gapped up from the previous day and closed right near the top of the trading range. This told us that not only did they change their mind and stop the selling, but they were already buying aggressively on the day that they made that harami. Bullish confirmation, again, a very strong uptrend. The higher they close on the previous day's candle, the higher the trajectory. Sometimes you're going to see a small candle down here at the very bottom. Means your trajectory could be more like this. The stronger they close up into the previous candle, that tells you there's been a change of investor sentiment. The bullish trend will now be relatively strong. And not only closing right near the top of the previous candle, that's as strong as you can get and still have a bullish harami, but also notice the tail down here. That also gives you information. It tells you the bears are still in control. Now all of a sudden, especially down here in the oversold area of the stochastics, the bulls stepped in, came back up through the open, and closed it right at the top of the previous day's open, or at the previous day's open. That's a strong reversal message, followed by a gap up, gives us a high probability that we're going to be starting up in a strong uptrend. Add up the elements. A bullish harami that closes near the top end of the trading range, number one. Number two, closes above the T line. Next day, they start trading positive. If you're a buyer, fine. If you don't buy on the, because it's not showing compelling strength, you've got a bullish harami, a doji, followed by a gap up. That whole combination tells you the bulls are definitely taking control. So always keep in mind that if you see a bullish harami, if it closes near the top end of the previous trading, expect a very strong move off that level. Close to the top of the trading range, gap up the next day, close above the T line. Uses the 50 as not as resistance, but they went right through the resistance, and now they came back to act as a support level, which it did start a very strong uptrend. And it doesn't matter what you name the signal. As long as it opens and closes within the previous day's candle, it can be called whatever you want to. For example, a bullish harami hammer signal still has the same parameters. You want to see a bullish open the next day. There we had a big inverted hammer. Following day we had a bullish harami. So if you combine these signals together, it tells you that there's probably been a change of investor sentiment. They're going to be starting this trend up fairly soon. The harami could be a spinning top. Anything that shows that it opened prior or above the previous day's close and closed above the previous day's open, it doesn't matter what you call it. Spinning top, inverted hammer, harami. Get ready for the buying. The harami tells you the selling has stopped. Inverted hammer, harami. Very simple. Watch to see how they open it the next day. In this case, they opened a positive and came all the way back up and closed above the T line, making it very simple for entry the next day. If you hadn't bought it on the positive open down here, you could be buying at this level, knowing that your upside potential is still fairly strong. A hammer harami represents the same thing. The bears tried to take it down, but they closed it back up in the trading range of the previous day, doing a hammer as well as a harami. Need the same clarification the next day. Bullish participation. It is time to buy. A spinning top doji followed by a gap up. That alone would be a buy signal. The fact that it was also a little harami in the previous big down candle in the oversold area is more evidence that the selling has stopped and the buying has started. A bullish harami left-right combo. Spinning top, bullish engulfing signal, followed by a gap up. Signifies the same thing. You could take all this apart, and each one would represent a situation where the buying was starting. The inverted hammer harami has the same parameters as if it was just a harami or just as an inverted hammer. If it opens positive the next day, you want to be a buyer. Where's your stop? Shouldn't come back down through this symbol or this signal right here. And anytime you see a doji as part of a signal, that represents more power if it turns the other way. This doji represents indecision. A move up from there tells you exactly what their decision was after this signal. So if you see a doji and a harami situation, a morning star, or any of the other signals where you have more than one day, and part of that is a doji, it's going to represent a much stronger reversal situation. A hammer harami Remember, it doesn't need to be significantly big. All it has to do is represent that the selling stopped and the bulls started stepping in. Then more confirmation with them gapping it up confirms that this told you that they were stopping the selling. It was time to buy. An inverted hammer harami followed by a hammer signal followed by bullish confirmation. Look at all these pieces together. Stochastics coming up clearly represents that the buying has started. Once you get this in your mind's eye, you start looking for these signals, especially if you're in an oversold situation. You start looking for buying. This reversal involved a bullish harami, inverted hammer, bullish confirmation closing above the T-line, starting the uptrend. Note how far away we've moved from the T-line relative to where it's been trading. Again, as many aspects or as many elements as you can put into your analysis of when a reversal is going to occur, the higher the probability that that reversal will be a profitable trade. Doji, harami, confirmation. Note how far away you are from the T-line. Where's your first viable target? See if it's going to resist at the T-line. One day, pulls back. Next day, takes it right back up. You stay long until you see a major reversal signal. Being able to visually recognize where a reversal signal occurs allows the investor to make a game plan of what needs to be done the next day instead of just jumping into trades when somebody else recommends them. All right, let's take a quick review of the different aspects of a bullish harami that makes them profitable. A bullish harami is very easy to recognize. It's a bullish candle inside the previous dark candle, usually at the end of a downtrend. It's also easy to identify because usually at the end of a downtrend, when you have that panic selling, it becomes a little bullish candle, again, inside an inside date in Western terminology, that eventually gets confirmed. And the harami can be a combination name. A doji harami, spinning top harami, inverted hammer, But the important factor is that it opens and closes inside the last big bullish candle, usually in an oversold condition, followed by bullish confirmation. And like all other candlestick signals, the further you move away from the T-line, the more likely it's going to come back up to it. Also, the higher they close in this last candle, the higher the probability of a good strong trend to the upside. Doji harami, good distance away from the T-line. Start watching for the reversal to occur. Look to see what happens once they get to the T-line. The bigger the signal, the higher the close, the further away it is from the T-line, the higher the probability it's going to have a strong reversal effect on the trend. And the harami becomes a very good signal to watch for, especially after panic selling at the bottom of a trend. Start watching to see when the buying comes in, and if it does form a harami, we know what to look for the next day. The bullish harami is a very effective reversal signal. Again, out of the 50 or 60 signals, there's only 12 that you really need to know, because those are the ones that are going to occur 99.99% of the time. So if you see a bullish harami, expect positive trading the next day. You know where your stop loss is. It shouldn't trade or close more than halfway down this candle. If it opens positive after a bullish harami, the probabilities are extremely strong that it's going to move higher from that level. This is not rocket science. This is merely observations that were profitable observations by Japanese race traders that made them legendarily wealthy. This concludes our training on the bullish harami. Again, one of the 12 major signals. This one is one of the most effective, especially on a positive open after the signal. The further away from the T-line, the higher the probability you've had a reversal occur. That'll be it. Thank you for listening.